Hi, this is Girish from Equity Master. Today, I'm going to talk to you about the current market scenario and the type of stocks you should buy, hold, and sell during the current crisis. The volatile nature of the market continues. March 2020 saw the full blown impact of the coronavirus. The BSE Sensex was down 23%. Then we had what you could call a relief rally in April that saw markets going up by 14%. Now, May is again turning out to be a negative month for the markets. The Sensex is down around 7 to 8% till date. Now, in terms of sectors, there are few that have been beaten down badly in this crisis. I have put the current and 3-year returns of the underperforming sectors here. While current year indicates the damage due to the coronavirus, the 3-year numbers indicates the picture before the virus. Now, if you see BSE Realty, that is the real estate sector, and the metal index, these were suffering even before the current crisis. This normally indicates a long term problem for these sectors. This was only exaggerated by the current crisis. On the opposite end, we have the outperformers, sectors which have been relatively immune to the crisis. Healthcare and telecom stand out the most. In fact, if you see the 3-year returns, you would see that these were underperformers just before COVID 19. Lockdown of the population, people working from home has meant a surge in data consumption. Naturally, telecom players have benefited. You can see that with the performance of the BSE telecom sector. Bharti Airtel's recent results have also shown the same. Also, healthcare has been in focus due to the crisis the world over. Now, this has been a health crisis. Indian pharma players are getting regulatory approvals to ship drugs now. This was not the case before. In fact, this was the main issue that was affecting pharma players over the last 3 to 4 years. This sector has been a strong outperformer in this crisis and is likely to continue for some more time. Now, I spoke to you about the market volatility before. These 23% declines, 14% up moves that we are seeing are monthly numbers. These are kind of changes that we are used to seeing in a year or more. Investors used to seeing these 200, 300 point moves are suddenly seeing 1000 to 2000 or even 3000 point moves regularly on a daily basis. Naturally, it can leave one confused. Also, these kind of daily moves forces investors to do a lot of rash stuff. Someone might be telling you this is an opportunity of a decade. Now, the vaccine for the COVID 19 virus will be announced anytime soon. This is what you hear sometimes on Twitter or social media. You end up buying something you shouldn't have. On the other hand, someone tells you the worst is yet to come. We are yet to reach the peak of this virus. They suggest you to stay away from the market. You then end up selling something you shouldn't have. Now, what should investors do in such a scenario? For investors, first and foremost, it will help a great deal if there is a clear process on what you should buy, hold, and sell in this current crisis. If you follow a logical, rational process, you are bound to do much better than the average investor. In subsequent slides, I will help you give a solid framework that will help you with your buy, sell, and hold decisions. We'll start with the easiest part first, but one that most investors get wrong. Also, the selling logic should always be the same in a normal or a bear market that we are seeing now. First thing I would like to say is sell your duds first. What do I mean by that? Sell businesses with poor business models. You will find the answers for these in financial numbers of these companies. Deteriorating operating margins, return ratios, slowing growth rates for years hint at a weak business. Also, avoid businesses with corporate governance issues. If you are holding them, these are the businesses that you should get rid of first. Any business with a questionable promoter will most likely give you pain and stress in the long run. The potential turnaround almost never happens, and you are likely to lose more money in the long run. Also, if you are convinced your stock faces either of the above two issues, then you should not look at your buy price. If the business is permanently damaged, you should sell even if you are facing a 50, 70, 90% decline. If you see past examples like a Unitech or a Suzlon, you'll see the stock prices have never recovered for years even after a 90 odd percent decline in these stocks. Holding on to such stocks will also impact your decision making process. You might end up selling a good business to buy more of your losers, which we call averaging down. It is much better to weed out such losers from your portfolio than holding on to them. Now, what are the stocks you already have and should hold on to? These would be the ones where you might be holding good companies but in unfavorable sectors. In the current scenario, it might be one from an NBFC, aviation, travel, or hospitality sector. Sectors that look dead to the general public right now. If you're holding stocks from these sectors, don't panic and be in a rush to sell. First, check if you're holding the best in the sector. A market leader in the sector will suffer much less than its peers. Then, do a check on its financial health. Are debt obligations low? Can it cover its fixed expenses for a year with no revenue? Is it backed by a top notch management? A management capable enough to tide over this crisis? If the answer is yes, these are the ones you can hold. Most likely, the bad news would be reflected in the price already. Finally, the big decision of the three: what to buy. At Equity Master, we always suggest a proper asset allocation framework for our subscribers. For retail investors, it makes sense to allocate 60-70% towards large cap stocks. Here, look at established brands that have dominated their sector for years. A lot of them might be attractive after a long time during the crisis. These are the stocks where you should be rest assured the business will survive. Prices might fluctuate in the near term, but in the long term, you know you are in a safe stock. In current uncertain times, where markets react sharply to every small news, these stocks will help you sleep well and not take any rash decisions. Now comes the tricky part: the balance 20 to 30% of your investment. The small cap space, a space where there will be a lot of pretenders. You will hear many false stories here. Stories of XYZ company as the next HDFC bank, etc. But if you get your small cap picks right here, the wealth creation opportunities are huge. This 20-30% part of the portfolio has the potential to multiply 3 to 5 times over the next few years. Even here, you should follow a very basic process to filter out the bad names. First and foremost, look at companies that can survive. Don't go looking after a stock that is corrected 50, 70, 90% and think that you're getting a cheap deal. Look at ones that are catering to the basic essential needs of the consumer. With solid numbers and a competent management back such a business, you are on the right path. The rewards for getting it right in the small cap space are huge. But remember, it also comes with greater risks. You can reduce these risks to a great extent if you take care of the basics. And by that, I mean you should focus on your asset allocation as we have suggested above for small and mid cap especially. With this, I would like to end this presentation. If you found this video helpful, don't forget to like this. I would love to hear your feedback on the comment section below. Also, don't forget to subscribe to our Equity Master channel for more such videos. Thank you.